Hey everyone, so if you're planning for retirement here in Georgia, you're probably thinking about long-term care. But a big question always pops up. How does it all affect your taxes? It's a huge concern for so many people, and today we're going to clear it all up for you.
All right, let's just get right to it. This is the question on everybody's mind, right? When that money from your long-term care policy starts coming in, does Uncle Sam get a piece of it? Is it taxable? It's a massive piece of your financial puzzle, so let's find out.
So, let's kick things off with the good news. When you get down to it, there's a general rule of thumb that gives a pretty simple answer. We'll start there before we dive into all the little details. And here it is, the short and sweet answer. For most folks out there, the benefits you get from your long-term care insurance policy are not taxable. You can breathe a sigh of relief on that one. But there is one really important condition. See, here's the key. For that money to stay tax-free, it has to be used for what the IRS calls qualified long-term care expenses. So what on earth does qualified actually mean? Let's break it down.
A qualified expense is basically any money you spend on care because of a chronic illness. Or, and this is the more common trigger, because you need a helping hand with at least 2 of the 6 activities of daily living, also known as ADLs.
And these ADLs are really just the basic, everyday tasks we all do to take care of ourselves. Things like eating, bathing, getting dressed, the fundamentals. If a doctor or nurse officially says you need substantial help with at least 2 of these 6 things, then your policy benefits can start to flow, and the money you spend on that care is considered a qualified expense.
Okay, so the main rule is simple enough, but you know how it goes. The devil's often in the details. There are a few key things hiding in the fine print that you absolutely need to understand to make sure every penny of your benefits stays tax-free. Let's take a look.
So there are really 4 big things to keep on your radar. You got to make sure your policy is qualified under IRS rules. You need to know about the daily benefit limit, there are some special rules for policies from work, and you might even be able to deduct your premiums. Now, they're all important, but today we're really going to zoom in on the one with a hard number you need to know, that per diem limit.
All right, let's talk about that daily limit, the per diem, as the IRS calls it. This is a big one because it's a specific number that the government sets each year, and it dictates how much you can receive tax-free every single day. For 2025, that magic number is $410 a day. Think of it as a tax-free ceiling. As long as your policy pays out that amount or less per day, you're in the clear. Now, it's a pretty generous amount for sure, but what if your policy pays more? So you might be wondering, what happens if my daily benefit is, say, $450? Well, that extra $40 could be considered taxable income, but here's the big exception. If your actual real-life care costs for that day were $450 or even more, then you're still totally fine. No taxes.
I know, this can sound like a lot to keep track of, but don't worry, getting that financial clarity is totally doable. It really just comes down to taking a few straightforward steps that can make all the difference in the world.
We found that a simple 3-step game plan works wonders. First, we help you just review your policy and make sure it's the right kind. Second, we analyze what you might actually need down the road. And third, we figure out how to make it all fit perfectly into your bigger retirement and tax strategy.
So that first step, reviewing your policy, what does that really do for you? Simple. It gives you peace of mind. It's that confidence you get from knowing for sure that you won't get hit with some surprise tax bill when you least expect it.
And step 2, analyzing your needs. This isn't just about crunching numbers. It's about making sure that when the time comes, your expenses will be fully covered. It lets you focus on your health, not on tax forms.
And finally, that third step ties it all together beautifully. When you weave this policy into your overall retirement plan, that's when you really see the magic happen. It leads directly to lower taxes and just a much stronger sense of financial security for your future.
So, after going through all these rules and numbers, what's the one thing you really need to walk away with today? Well, it all boils down to one simple word: planning.
Here's the bottom line. A little proactive planning today protects you from huge headaches and unwanted tax surprises tomorrow. It's really about making sure your benefits are there for you, tax-free, exactly when you need them most. You're protecting your health, your wealth, and your family's future.
If any of this has you thinking about your own retirement plan and you have some questions, you can learn more about us at Georgia Safe Retirement Planners.
Just visit our website or click that link in the description. Remember, a little planning today is the key to a secure and worry-free future.